Hey there. Welcome to your personalized deep dive.
Yeah.
Today we're tackling something that can feel like a bit of a jungle,
Mm-hmm.
tax and estate planning,
Yes.
especially for high-income earners in California like you.
Right.
We've got all your sources ready to go, YouTube videos,
Mm-hmm.
legal guides, the whole shebang.
Yep.
And we're on a mission to extract the juiciest strategies to help you feel informed and in control of your financial future.
You know what I find fascinating about this topic?
What's that?
It's how it goes beyond just minimizing those taxes.
Right.
It's about taking control and really shaping your financial legacy
Yeah,
and making sure that your wealth benefits you and your loved ones for years to come.
exactly. So let's unpack this, starting with California's tax landscape.
Right.
I mean, there's no secret that the Golden State can be a bit of a tax burden,
Oh, yeah.
especially for high earners.
It's true.
Lay it on us.
For 2024, single filers, they see a top state income tax rate of 13.3%, and that kicks in at just over $1 million of income. That's compared to a top federal rate of 37%, but that's not until you hit over $578,125.
Okay.
So you're dealing with a much higher state tax burden here in California.
Wow. 13.3% just to California alone?
Yeah,
That's a serious chunk of change.
it is.
So knowing that, what are some strategies folks can use to navigate this?
Well, real estate investors,
Okay.
they can look into something called a 1031 exchange.
Okay.
This lets you defer capital gains taxes when you sell an investment property
Okay.
and roll those proceeds into a similar one.
Right.
It's basically a way to keep that money working for you
Right.
without that immediate tax hit.
That's a powerful tool.
It is.
I've always wondered, though.
What's
The
that?
taxes are never paid then, right?
Not necessarily. They're deferred until you sell that replacement property without using another exchange.
Right.
But here's a cool thing.
Yeah.
If you hold that property until death, a step-up in basis kicks in.
Okay, hold on.
And that could potentially wipe out those capital gains taxes for your heirs.
Step up in basis.
Yes.
Explain it to me like I'm 5.
All right. Think of it as a reset button.
Okay.
The property's value is adjusted to its market value at the time of death,
Right.
essentially eliminating the capital gains accumulated during your lifetime.
Oh, okay.
So your heirs inherit the property at that new, higher value,
Right.
potentially sidestepping a huge tax bill.
That's incredible.
It is.
So 1031 exchanges paired with this step up in basis, that sounds like a fantastic combination for leaving a lasting legacy for your family.
They can be,
Right.
but remember, it's crucial to involve qualified professionals to make sure everything's done correctly.
Of course, yeah.
There are very specific rules and timelines involved.
Great point.
Yeah.
Now, beyond real estate, are there any other innovative ways to minimize that overall tax liability?
One interesting approach is to offset capital gains using deductions from other areas.
Okay.
For instance, investing in oil and gas projects.
Okay.
With intangible drilling costs, IDCs, can create significant deductions up front, potentially offsetting gains elsewhere.
Wait, oil and gas.
Yeah.
With the move toward renewable energy, wouldn't that be kind of a risky move?
It's true that oil and gas comes with their own set of risks.
Right.
But they can offer attractive tax benefits.
Okay.
And while the world is transitioning to cleaner energy, oil and gas is likely going to remain a part of the mix
Right.
for years to come.
Okay.
Still, thorough research and understanding the risks is vital before jumping into any investment.
That's a good reminder,
Yeah,
especially as this might be new territory for some listeners.
right.
Now, I've also heard about solar investment tax credits.
Yeah.
Aren't those just for homeowners putting up solar panels?
Not exclusively.
Right.
Investors in solar projects can benefit too.
Really?
You could see a potential 30% tax credit on that investment.
Wow.
Plus, those investments can generate cash flow
Okay.
through electricity sales or lease payments, depending on how it's structured.
So you get tax savings while supporting renewable energy.
Exactly.
2 birds, 1 stone.
It's all about finding what aligns with your values and financial goals.
Okay, we've covered some tax saving tactics.
Yep.
Now let's shift gears to estate planning.
Right.
Why is this so crucial, especially for high-income Californians?
It's vital for everyone,
Right.
but even more so when you have those significant assets.
Mhm.
Estate planning ensures your wealth is protected,
Right.
distributed according to your wishes,
Mhm.
and your loved ones are taken care of.
Right, because let's face it,
Yeah.
nobody enjoys thinking about what happens after they're gone.
Yeah,
But it's a conversation we all need to have.
It is.
So where do we even begin with this? What are the core elements?
The cornerstone
Okay.
is a will,
Okay.
outlining how you want your assets divided after you pass.
Okay.
But for high-income individuals,
Yeah.
trusts often become a more powerful tool.
I've always been a little fuzzy on the difference between a will and a trust. Can you break that down for me?
Think of a will as a public document
Okay.
that goes through probate court,
Okay.
which can be time-consuming and expensive.
Right.
A trust, however,
Okay.
is a private legal agreement
Okay.
where you transfer assets to a trustee who manages them for your beneficiaries.
Gotcha.
Trusts can bypass probate, offering more flexibility and privacy.
So for those who value control and privacy over their assets, trusts seem like the way to go.
Absolutely.
Okay.
And there are different types, each with their own perks.
Okay.
A revocable living trust lets you make changes during your lifetime,
Okay.
while irrevocable trusts, where you relinquish control, offer greater tax advantages and asset protection.
Irrevocable trusts sound intriguing,
Yeah.
but giving up that control seems like a big step.
It can be, but they can also be incredibly powerful.
Okay.
Take dynasty trusts, for example.
Okay.
These can pass wealth down through multiple generations,
Wow.
minimizing estate taxes and potentially shielding assets from creditors.
Dynasty trusts sound like something out of a movie.
They do, right?
Is that really a thing?
It might sound fancy, but it's a legitimate strategy.
Wow.
It's all about thinking long-term
Okay.
and preserving wealth for your descendants.
That's fascinating.
Yeah.
So we've got wills and trusts.
Yeah.
What other options are there for protecting your assets?
LLCs, or limited liability companies, are popular for business owners.
Okay.
They shield your personal assets from business debts and lawsuits.
Right.
And while they require careful planning and can be subject to scrutiny,
Mm-hmm.
offshore trusts can also be a tool for asset protection
Okay.
in certain situations.
LLCs make sense for businesses, but what about protecting personal assets?
Sure.
Like your home.
That's where things like the homestead exemption come in.
Okay.
It safeguards a portion of your primary residence's equity from creditors.
Right.
In California, that can range from $300,000 to $600,000, depending on your county.
Wow, that's a significant safety net. Any other ways to shield your home from potential lawsuits?
For married couples, tenancy by the entirety can protect that jointly owned home from creditors of just one spouse.
Right.
And don't forget about umbrella insurance.
Oh, yeah.
It provides that extra liability coverage beyond your standard homeowner's policy.
Umbrella insurance, right? That's often overlooked.
It is.
But it's such a valuable asset protection tool.
Absolutely.
Man.
Since we're talking about California, we can't forget about community property laws and their impact on estate planning.
Community property, that's something I need to brush up on.
Okay.
Can you explain how that works?
California is a community property state.
Okay.
This means assets acquired during marriage are generally considered equally owned by both spouses.
Okay.
This includes income, investments, even retirement accounts.
Gotcha. Okay.
Yeah.
So how does that play into estate planning?
You need to be mindful of these laws when creating your will or trust.
Okay.
It's about ensuring your assets are distributed as you wish, while respecting your spouse's community property rights.
So what are some specific strategies for navigating community property and estate planning?
Prenuptial or postnuptial agreements are valuable tools.
Oh,
They allow couples to clearly define separate and community property,
right.
minimizing potential disputes,
Okay.
and specific language can be used in your will or trust to address these concerns.
So prenuptial agreements aren't just for the super rich.
Not at all.
Okay.
They can be beneficial for any couple,
Right.
especially in community property states like California.
Gotcha.
It's about clarity and protecting both spouses.
Good to know.
Yeah.
Now, how can trust specifically protect real estate assets?
They're incredibly powerful for this.
Okay.
By holding real estate in a trust, you can bypass probate,
Right.
potentially lower estate taxes,
Hmm.
and even facilitate 1031 exchanges for deferring those capital gains.
Wow.
Trusts offer a lot of flexibility for real estate owners.
So it's like a secret weapon for real estate investors.
It can feel that way. Trusts offer a level of control and protection that's hard to beat,
Okay.
especially when it comes to real estate.
Okay. We've covered the basics and touched on some advanced strategies.
Mm-hmm.
Now let's dive deeper into specific trust types.
Okay.
Beneficial for high-income Californians.
Let's start with the Charitable Remainder Trust, or CRT.
Okay, I've heard of CRTs, but need a refresher.
Okay.
How do they work exactly?
Imagine donating assets to charity
Okay.
while still receiving income from them
Okay.
for a set period or even your lifetime.
Gotcha.
You're supporting your favorite cause while also benefiting yourself.
That sounds like a win-win.
It is.
What about the tax implications?
You receive an immediate income tax deduction for those donated assets.
Okay.
Plus, those assets are eventually excluded from your taxable estate, reducing potential estate taxes.
Wow.
It beautifully blends philanthropy with tax efficiency.
Okay, so CRTs are for those looking to give back
Yep.
and reap some tax benefits. What about those prioritizing charitable giving, but still wanting to pass wealth down to family?
Okay.
Is there a trust for that?
You're thinking of a charitable-led trust, or CLT.
Okay.
It's like a reverse CRT.
Okay.
You provide income to a charity for a specific time.
Gotcha.
Then the remaining assets go to your beneficiaries, usually family.
So you're creating a temporary charitable foundation.
That's a great way to put it.
Okay.
CLTs are powerful for reducing estate and gift taxes
Okay.
because that charitable deduction lowers your taxable estate's overall value.
Right.
Plus, you're supporting a cause you care about.
Okay, CRTs and CLTs are for the philanthropists.
Yeah.
Are there trusts specifically designed to minimize taxes when transferring assets to heirs?
Absolutely.
Okay.
One of the most popular is the Grantor Retained Annuity Trust, or GRETS.
Okay.
It allows you to transfer appreciating assets to an irrevocable trust
Okay.
while receiving an annuity payment for a set period.
So you're transferring future appreciation to your beneficiaries.
Right. But still getting income from it.
That's it.
Okay.
The annuity payments are calculated to minimize gift tax liability.
Gotcha.
It's a sophisticated technique for transferring wealth to heirs with minimal tax consequences.
GR tax sound complex.
They can be.
Are there any simpler ways to reduce estate taxes when gifting assets?
There are.
Okay.
The annual gift tax exclusion is great for smaller gifts
Okay.
without incurring tax.
Mhm.
In 2023, it's $17,000 per recipient.
Okay.
You can gift up to that amount to as many people as you want tax-free.
Wow.
Then there's the lifetime gift tax exemption, currently $12.92 million per person,
Wow.
or $25.84 million for couples.
Okay.
Anything above that will be subject to gift tax.
So it's like having a gift tax allowance.
Precisely.
Okay.
It's a valuable tool for reducing your taxable estate and passing wealth to loved ones tax efficiently.
We've covered a lot of ground with trusts.
Yeah.
It's clear why they're so popular for estate planning.
Mm-hmm.
But let's not forget about retirement planning.
It's a critical piece of the puzzle, especially for high earners in California who might face higher tax rates in retirement.
You're absolutely right.
Yeah.
And there are a lot of moving parts when it comes to retirement planning.
Okay.
We need to break this down strategically.
All right, let's do it.
Okay.
What are some of the key considerations for retirement planning that we should be thinking about?
First things first. Identifying your income sources.
Okay.
Will you rely on Social Security, pensions, personal savings?
Right.
And how will you manage those streams to
Mhm.
make sure they last throughout your retirement?
Right. You definitely don't want to outlive your savings.
Exactly.
That's a scary thought.
And that's where strategies like the bucket strategy become really useful.
Okay.
Imagine dividing your retirement savings into 3 buckets.
Okay.
Short-term needs,
Okay.
intermediate-term needs,
Okay.
and long-term growth.
I like the idea of buckets.
Yeah,
It makes retirement planning feel less overwhelming.
right.
How do you decide what goes into each bucket?
The short-term bucket covers immediate needs, like living expenses for the first few years of retirement.
Oh.
It's invested in safe, liquid assets,
Right.
like cash or money market funds.
So it's like your emergency fund, but for retirement.
Exactly.
Okay.
The intermediate-term bucket is for expenses you'll incur in the next 5 to 10 years.
Okay.
This bucket can be a bit more aggressive
Mm.
with a mix of stocks and bonds.
Okay. That makes sense.
Yep.
And what about the long-term bucket?
That's your growth engine, typically invested in stocks,
Okay.
to outpace inflation and provide income for your later years.
So it's a tiered approach to retirement planning,
Yeah.
gradually shifting from safety to growth
Right.
as you move through retirement.
You got it.
Okay.
The bucket strategy is a simple but effective way to manage your retirement income
Okay.
and mitigate market risk.
Okay, we've got income sources and the bucket strategy down.
Mm-hmm.
What about specific retirement accounts?
Okay.
I'm familiar with traditional IRAs and 401ks.
Sure.
But are there other options, especially for high earners?
There are.
Okay.
Roth IRAs are a popular choice.
Okay.
Contributions are made with after-tax dollars,
Right.
but withdrawals in retirement are tax-free.
Okay.
This is a huge advantage if you expect to be in a higher tax bracket later in life.
So you pay taxes up front to avoid paying them later on.
That's the idea.
Okay.
And for those who exceed the Roth IRA income limits,
Right.
There's the backdoor Roth strategy.
Backdoor Roth, okay.
It involves contributing to a traditional IRA and then converting it to a Roth IRA.
Okay,
There are some specific rules to follow,
right.
but it's a great option for high earners.
Backdoor Roth. We're definitely going to need a deep dive on that later.
We can do that.
Now, what about those who are self-employed or own small businesses?
Yeah,
Are the retirement plans specifically for them?
absolutely.
Okay.
Solo 401ks are fantastic for the self-employed and small business owners.
Okay.
They offer higher contribution limits than traditional IRAs.
Gotcha.
And can be structured as either traditional or Roth accounts.
So more flexibility and potentially more tax savings.
Exactly. And there's even a mega Roth strategy that utilizes solo 401ks to supercharge your retirement savings.
Mega Roth.
Yes.
You're speaking my language.
I know.
We'll have to dedicate a whole deep dive to exploring those advanced retirement planning strategies.
That's good.
But for now, let's switch gears and talk about asset protection.
All right.
It seems like something only for the ultra-wealthy.
Not at all.
Okay.
Asset protection is about safeguarding your hard-earned wealth
Mm-hmm.
from potential threats,
Right.
like lawsuits, creditors,
Yeah.
even divorce.
Right.
It's about creating a buffer between your assets
Yeah.
and those who might try to take them.
Okay, so it's like building a fortress around your wealth.
Exactly.
How do you actually go about protecting your assets?
There are a variety of strategies,
Okay.
and the best approach depends on your specific circumstances
Right.
and the types of assets you own.
Okay. We've already talked about some, like LLCs, trusts, and the homestead exemption.
Right.
But there are other techniques.
Okay.
Like equity stripping,
Okay.
where you place a lien on your property to deter creditors.
Right.
Then there are domestic asset protection trusts, or DIPTs,
Okay.
which are irrevocable trusts designed specifically to shield assets from creditors.
Equity stripping sounds a bit risky.
It can be.
Okay.
So it's important to proceed with caution,
Right.
but it can be effective in certain situations.
Okay.
And DIPTs are becoming increasingly popular for asset protection,
DAPTs.
especially for those in high-risk professions.
Gotcha. DAPTs, another one for the deep dive list.
Yes,
I'm learning so much about all these different strategies.
I'm glad.
Before we wrap up asset protection,
Okay.
let's talk about IRS audits.
All right.
It can be a nightmare for anyone.
It can.
Are there ways to minimize the risk of being audited?
Absolutely.
Okay, tell me. The most important thing is to file your tax returns accurately and on time.
Right.
The IRS is very good at flagging errors and inconsistencies, so accuracy is key.
Okay.
Also, ensure you can justify any deductions or credits you claim, and keep detailed records and receipts.
Okay.
Having proper documentation is crucial if you're ever audited.
So it's like the Boy Scout motto.
Yeah.
Be prepared.
Exactly.
Yeah.
And if you're ever unsure about anything, consult a qualified tax professional.
Right.
They can help navigate the tax code and minimize your audit risk.
Great advice.
Yeah.
We've covered so much in this deep dive. California's tax landscape,
Mm-hmm.
estate planning strategies,
Yes.
asset protection techniques.
It's a lot.
It's a lot to absorb, but hopefully you're feeling more informed and empowered
Yeah.
to make smart financial decisions.
I hope so too.
Yeah,
Remember, this is just the start.
right.
Take this knowledge and apply it to your situation.
Mm.
And don't hesitate to seek guidance from experienced professionals who can help you tailor a plan to meet your specific needs.
Exactly. This deep dive is like a roadmap showing you the different paths you can take.
Right.
You get to choose the best route for you.
Yeah.
And don't forget, this is just part one of our journey. We've got more exciting topics to explore
Mhm.
in the next 2 parts, so stay tuned and keep those questions coming.
We're looking forward to diving deeper into some of these advanced strategies
Okay.
and uncovering even more ways to help you protect and grow your wealth.
Absolutely. Until next time, happy planning.
Welcome back to your personalized deep dive into the world of tax and estate planning.
All right, picking up where we left off.
Yeah.
Let's explore a strategy
Okay.
used by many high net worth individuals,
Right.
particularly in California,
Mm.
moving out of state to potentially lower their tax burden.
Now, this is something I've heard whispers about.
Is it really possible to escape California's high taxes just by moving?
It can be, but it's not as simple as just packing your bags
Right.
and heading to a state with no income tax.
Right. You need a solid strategy
Okay.
to sever ties with California completely
Right.
and avoid any residency issues.
I bet California probably doesn't let go of those high earners so easily.
Right.
What are some pitfalls to watch out for?
California is known for rigorously pursuing former residents.
Okay.
They believe haven't genuinely established residency elsewhere.
Right.
They'll look at things like how much time you spend in the state,
Okay.
where your financial accounts are located,
Okay.
even your voter registration.
Wow, they really do their homework.
They do.
It sounds like you need to be incredibly meticulous about documenting your move
Right.
and establishing a clear presence in your new home state.
Absolutely. Working with professionals who understand the nuances of residency rules is crucial.
Okay.
They can guide you through the process
Right.
and help ensure a smooth transition.
So for those ready to take the leap, which states are considered tax havens?
8 states have no income tax at all.
Okay, let's hear them.
Alaska, Florida.
Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming.
No income tax. That's tempting.
It is.
But what about other taxes?
Yeah.
Like property taxes or sale taxes?
Sure.
Do those come into play as well?
They do.
Okay.
And they vary from state to state.
Okay.
It's essential to look at the whole picture,
Right.
not just income tax.
Right.
A state might have low income tax, but higher property taxes, for example.
Gotcha.
It's all about finding the right balance
Right.
for your individual situation.
That makes sense. You've got to weigh all the factors.
Right.
Let's say you've successfully moved out of California.
Okay.
What other tax optimization strategies can you use to reduce your liability even further?
Great question. There are always ways to refine your tax plan.
Okay.
One area to focus on is income management,
Okay.
especially if you're a business owner or self-employed.
Okay. Income management.
Yep.
What are some techniques that would be beneficial?
One strategy is strategically timing your income recognition. If you have a particularly high income year,
Right.
you might consider deferring some of that income
Right.
to a year when you're in a lower tax bracket.
Gotcha.
Conversely, you could accelerate income into the current year
Yep.
if you anticipate being in a higher tax bracket in the future.
So it's like playing chess with your income,
It is.
making strategic moves to minimize your tax liability.
Exactly. It's about being proactive and anticipating future tax implications.
I like that. Thinking ahead and planning strategically.
Yeah.
What other income management tools are out there?
Another powerful one is optimizing your compensation structure,
Okay.
particularly as a business owner.
Okay.
This could involve maximizing pre-tax retirement contributions,
Okay.
utilizing deferred compensation plans,
Right.
or even structuring your compensation
Right.
to reduce self-employment tax liability.
So it's about being smart with how you receive and manage your income,
It is.
working with your tax advisors to find the most efficient approach for your specific situation. Speaking of self-employment tax,
Yes,
I know that's a burden for many business owners.
it is.
Are there ways to lessen that impact?
Definitely. Self-employment tax can really eat into your profits.
It can.
One option is incorporating your business as an S corporation.
Go.
This allows you to take a salary, which is subject to payroll taxes,
Okay.
but also receive distributions of profits, which aren't subject to self-employment tax.
So you're essentially dividing your income into 2 buckets, one with lower taxes and one with higher taxes.
That's a great way to put it.
Okay.
It's a common strategy for S-corp owners to reduce their overall tax liability.
Interesting. Are there other ways to minimize self-employment tax, or is that the main one?
There are other strategies,
Okay.
but they can be quite complex
Okay.
and often require specialized knowledge.
Right.
For example, certain retirement plan structures,
Yeah.
like defined benefit plans,
Okay.
can shelter a significant portion of your self-employment income from taxes.
Okay, those sound like they're a bit beyond the scope of our conversation today.
Yeah,
But it's good to know there are options for those who really want to minimize that burden.
there are.
Now, shifting gears a bit,
Okay.
let's talk about something that every homeowner and investor should understand.
Okay.
Depreciation.
Depreciation, yeah.
It's a powerful tax benefit,
It is.
but I've always found it a bit confusing.
It's a common point of confusion.
Can you clear it up for us?
Essentially, depreciation allows you to deduct a portion of the cost of a depreciable asset,
Okay.
like a building or equipment,
Mhm.
each year over its useful life.
So you're spreading out the cost of the asset over its lifetime.
Right.
And deducting a portion of that each year.
Exactly.
Okay.
And that deduction reduces your taxable income,
Right.
which lowers your tax liability.
Okay, I see how that's a valuable benefit.
Yeah.
But how do you figure out the depreciation schedule for an asset?
Sure.
Is it different for different things?
The IRS has specific rules and guidelines
Right.
for depreciating in different types of assets.
Okay.
They determine the useful life of the asset
Right.
and the depreciation method that can be used.
So it's not something you can just decide on your own. You have to follow specific IRS rules.
Definitely. It's important to follow those guidelines to avoid any issues.
Right.
There are also different depreciation methods,
Okay.
like straight line depreciation,
Okay.
where the cost is evenly spread out over the asset's life,
Okay.
and accelerated depreciation,
But
where you can deduct a larger portion of the cost in the early years.
accelerated depreciation sounds like it could lead to bigger tax savings up front. Is that right?
It can,
Okay.
but it's crucial to understand the long-term implications.
Right.
Accelerated depreciation might lower your taxes in the short term,
Okay.
but it can also result in higher taxes
Right.
when you eventually sell the asset.
So it's a trade-off. You're shifting the tax burden to a later date.
That's one way to think about it.
Okay.
It's essential to weigh the pros and cons of each method and choose the one that aligns with your overall tax strategy.
Now, I've also heard of something called cost segregation studies.
Yes,
How do those relate to depreciation, if at all?
cost segregation studies are a specialized technique
Okay.
used to maximize depreciation deductions on real estate investments.
Okay.
They involve identifying and classifying the various components of a building
Okay.
that can be depreciated separately.
So instead of depreciating the whole building as one asset, you break it down into smaller parts. Is that the idea?
You got it.
Okay.
Different components have different useful lives and depreciation schedules.
Okay.
For example, certain building systems,
Right.
like plumbing or electrical,
Right.
might have shorter useful lives than the building structure itself.
Okay.
By segregating these components, you can potentially accelerate depreciation and generate significant tax savings.
Cost segregation studies sound pretty complex.
They can be.
Are they worth the effort for most real estate investors?
They can be incredibly valuable, especially for large-scale real estate projects.
Okay.
It's crucial to work with qualified professionals
Well,
who specialize in cost segregation.
right.
They can determine if a study is right for you
Yeah.
and ensure it's done correctly.
Makes sense. It's always best to have expert guidance for these complex strategies.
Absolutely.
Now, before we move on, there's one term I've heard thrown around
Okay.
that I'm curious about. Real estate professional.
Mhm.
What does that mean, and how does it relate to taxes?
The real estate professional designation is a special tax status
Good.
with significant benefits
Ugh.
for those actively involved in the real estate industry.
Okay.
If you meet the IRS requirements for this status,
Right.
you can deduct rental real estate losses against your other income,
Okay.
even if those losses exceed the passive activity loss limitations.
Hold on. Passive activity loss limitations.
Yeah.
Can you explain that in a way that makes sense to someone who isn't a tax expert?
Of course, think of it like this. The IRS doesn't want you using losses from your rental properties to offset income from your regular job
Right.
unless you're truly a real estate professional.
Okay.
These limitations are designed to prevent people from using rental losses to shelter other income unfairly.
So it's like a special exception for those who are genuinely engaged in the real estate business.
Exactly.
Okay.
It can be a valuable tax strategy
Right.
for those actively involved in the industry, like developers, brokers, or property managers.
But I'm guessing it's not easy to qualify for that status. What does it take?
You're right, it's not a free pass.
Oh, yeah.
There are specific requirements
Okay.
regarding the amount of time you spend on real estate activities
Mhm.
and the nature of those activities.
So owning a rental property or two isn't enough to qualify.
Right.
You have to be seriously involved in the industry.
You nailed it.
Okay.
It's for those who are truly dedicated to real estate as a profession.
Wow. We've covered a lot of ground today. From tax planning strategies and moving out of state
Yep.
to depreciation and the real estate professional status.
Yeah,
It's definitely a lot to digest.
it is.
But I'm starting to see how all these pieces fit together.
That's what we're aiming for, to help you see the bigger picture
Right.
and understand the tools available to protect and grow your wealth.
And it's definitely empowering to realize how many strategies are out there
It is.
and how we can be proactive about shaping our financial futures
Absolutely. It's all about taking control and planning strategically.
and seeking guidance from experienced professionals, of course.
Yes.
They can help create a personalized plan
Right.
that addresses your specific needs.
Exactly. As we wrap up this part of our deep dive,
Okay.
I want to leave you with this thought.
Okay.
Tax and estate planning aren't one-time events.
Right.
They're ongoing processes
Right.
that require regular review and adjustments
Okay.
as your life and the tax laws change.
That's an important reminder. It's not about setting it and forgetting it. We need to stay informed and be ready to adapt.
Precisely. And in our final part, we'll explore some additional strategies for optimizing your financial plan
Duh.
and staying ahead of the curve.
I can't wait to hear what else we uncover. Until next time,
Sounds good.
welcome back for the final part of our deep dive into tax and estate planning. We've covered a ton of ground, from minimizing taxes to protecting your assets. Now I'm excited to explore some advanced strategies that can take your financial plan to the next level. What's in store for us today?
Let's start by revisiting charitable giving. We touched on charitable remainder trusts and charitable lead trusts, but there are other creative ways to incorporate philanthropy into your financial plan.
I'm all ears. I've always been passionate about giving back, but I haven't thought much about how it connects with my overall financial strategy.
It's often overlooked, but it can be incredibly rewarding both personally and financially. One strategy to consider is setting up a private foundation.
A private foundation. That sounds like something only billionaires do.
Not necessarily. While private foundations are often associated with the ultra-wealthy, they can be a valuable tool for anyone who wants to make a significant and lasting impact with their charitable giving.
Okay, so what exactly is a private foundation and how does it work? I have to admit, I don't know much about them.
Think of it as a nonprofit organization that you create and control. You can donate assets to the foundation and then direct those funds to your chosen charities over time.
So it's like having your own personal charity fund.
That's a great way to put it. One of the major benefits is that you get to decide how the funds are used. You can create specific grant programs, support particular causes, or even fund research initiatives. It gives you a lot of control over your philanthropic endeavors.
That sounds really appealing. But what about the tax benefits? Are there any advantages to using a private foundation?
Absolutely. Contributions to your private foundation are deductible from your taxable income, which can lower your tax liability. Plus, the foundation's assets grow tax-free, similar to a retirement account.
So it's a win-win. You support the causes you care about and potentially save on taxes. This is making more and more sense.
It's definitely a strategy worth considering if you're passionate about philanthropy. However, private foundations do come with some administrative complexities. They have to file annual tax returns and adhere to specific regulations.
So it's not something you set up and forget about. It requires ongoing management.
That's right. It requires ongoing management and oversight, but the rewards can be substantial.
Okay, I'm adding private foundations to my list to explore further. What other charitable giving strategies should we discuss?
Another popular option is a donor-advised fund, or DAF. Think of it as a simpler, more streamlined version of a private foundation.
Interesting. How so?
With a DF, you donate assets to a sponsoring organization, like a community foundation or a financial institution. You receive an immediate tax deduction for your donation, and the sponsoring organization manages the funds and handles all the administrative tasks.
So you're essentially outsourcing the management of your charitable giving.
Exactly. It's a great option for those who want to make a difference without the complexities of running their own foundation.
DAFs sound like a fantastic alternative. Are there any downsides to using them?
One potential drawback is that you relinquish some control over the funds. Once you donate to a DAF, you can't take the assets back. You can only recommend grants to charities, and the sponsoring organization has the final say on approval.
So you're putting your trust in the sponsoring organization to make responsible decisions with those funds.
That's right. It's crucial to choose a sponsoring organization that aligns with your values and has a strong track record of grant making. Do your research and make sure you feel confident in their ability to carry out your philanthropic vision.
That's a great point. Now, before we move on from charitable giving, I'm curious about how it can be woven into estate planning. We talked about CRTs and CLTs, but are there other ways to incorporate philanthropy into your legacy?
Absolutely. One simple yet powerful strategy is to include a charitable bequest in your will or trust. This designates a portion of your assets to be donated to charity after you pass.
So it's like a final parting gift to a cause you believe in.
Exactly. It's a meaningful way to extend your philanthropic impact beyond your lifetime and leave a lasting legacy of generosity.
I love that. Now, let's shift gears and talk about something that can be sensitive, but it's incredibly important. Planning for potential family disputes. Disagreements happen, and they can sometimes derail even the most carefully crafted estate plan.
It's true, family dynamics can be complex, and estate planning often brings those complexities to the forefront. But there are steps you can take to minimize the potential for conflict and ensure your wishes are respected.
Okay, what are some strategies for preventing family disputes during the estate planning process?
Open and honest communication is key. Talk to your family members about your estate plan. Explain your decisions, address their concerns, and make sure everyone understands your intentions. Transparency can go a long way in preventing misunderstandings and resentment down the road.
That makes sense. But what if communication alone isn't enough? What if there are already tensions simmering within the family?
In those cases, it might be helpful to involve a neutral third party, like a mediator or an estate planning attorney. They can facilitate productive conversations, help everyone find common ground, and create a plan that works for the whole family.
So it's like having a referee for family discussions about estate planning.
Exactly. Sometimes simply having a neutral presence can de-escalate tension and allow for more rational decision-making.
Good point. Besides communication and mediation, are there any other tactics for preventing disputes?
Being clear and specific in your estate planning documents is essential. Avoid ambiguity and use precise language to outline your wishes. This minimizes the potential for misinterpretations and legal challenges later on.
So it's like writing a contract, making sure every detail is clearly spelled out and there's no room for confusion.
That's a perfect analogy. And if you're concerned about potential challenges to your estate plan, you can include a no contest clause. This clause states that any beneficiary who contests the will or trust will be disinherited.
Wow, that's a powerful deterrent. But I imagine it's not always foolproof. Are there times when it might not be effective?
You're right, there are situations where a no contest clause may not hold up in court. But it can be an effective tool in many cases. It's all about understanding the risks and benefits and making informed decisions.
Okay, so we've talked about preventing family disputes, but what happens if one arises despite everyone's best efforts? What's the next step?
If a dispute can't be resolved through communication or mediation, it might end up in court. That's why having a well-drafted estate plan that clearly outlines your wishes and is legally sound is crucial. A strong legal foundation can help you navigate any challenges that may arise.
So it's like having insurance for your estate plan. You're protecting your wishes and minimizing potential risks.
Exactly. It's all about protecting your legacy and making sure your intentions are carried out.
Well, we've certainly covered a lot of ground in this entire deep dive, from California's unique tax landscape and those tricky estate planning strategies to asset protection techniques and even charitable giving. It's been quite a journey.
It has. And remember, it's a journey that continues even after this deep dive ends.
That's right. The key takeaway here is that this isn't a one-and-done deal.
Absolutely not. Tax laws are constantly changing.
Right.
Your life circumstances are evolving.
Yep.
So proactive planning, regular reviews, and staying informed are critical for long-term success.
Couldn't have said it better myself. To our listeners, remember, this is your deep dive.
That's right.
And the real journey begins when you take this knowledge and apply it to your own unique situation. We encourage you to explore those strategies that resonated with you, seek expert advice, and start shaping your financial future. Until next time, happy planning.
Happy planning.